Recommending actions based on financial analysis requires transforming data-driven insight into strategic decision-making. It is not enough to describe or diagnose performance. Finance professionals must prescribe interventions that enhance value creation across the organization. Predictive and prescriptive analytics play a central role in this process. Predictive ratios, such as forecasted return on equity, ROE, projected cash conversion cycles, or expected interest coverage, anticipate future trends, enabling proactive planning. Prescriptive analytics goes a step further by evaluating alternative courses of action and selecting the optimal one based on financial and non-financial implications. This evolution from analysis to action defines the mature end of the Gartner analytics spectrum, where data intelligence directly informs strategic decisions, investment priorities, and risk mitigation strategies. Effective recommendations depend on understanding the linkages between different areas of performance. Profitability cannot be enhanced in isolation from liquidity, solvency, and operational efficiency. For example, improving gross margin through higher prices may harm sales volume and cash flow. Conversely, aggressive credit policies may boost revenue but weaken working capital. Integrated ratio interpretation, linking return on assets, ROA, to inventory turnover, debt ratios, and cash flow efficiency, reveals the ripple effects of decisions across the value chain. Recognizing these interconnections prevents optimization in one area at the expense of another. Finance professionals must, therefore, approach recommendations holistically, ensuring that performance improvements align with strategic, operational, and sustainability goals. Predictive ratios enable forward-looking recommendations grounded in quantitative modeling. For instance, forecasting liquidity ratios under alternative sales growth or cost scenarios helps determine funding needs and timing. Predictive modeling can identify leading indicators, such as rising receivables days or declining asset turnover, that signal emerging risks before they materialize. By converting ratio trends into predictive scenarios, management accountants provide early warnings and scenario-based action plans. These predictive tools bridge historical data with strategic foresight, transforming static financial statements into dynamic planning instruments. They guide management in optimizing investment, financing, and dividend policies for sustainable growth. Prescriptive ratios combine predictive insights with optimization logic to recommend the best course of action. For example, sensitivity analysis on leverage ratios may suggest refinancing debt to reduce interest burden while maintaining acceptable gearing. Similarly, prescriptive working capital ratios can identify optimal inventory levels balancing liquidity and service quality. These recommendations integrate analytics with managerial judgment, ensuring that actions are not only financially sound but also operationally feasible. The finance professional's role evolves from reporting past performance to guiding strategic change, using ratio-driven prescriptions to improve efficiency, profitability, and stakeholder value simultaneously. Recommending actions also requires aligning financial insights with the organization's business model and strategic intent. A prescriptive ratio may show the need to reduce costs, but the appropriate response depends on whether the firm competes through cost leadership, differentiation, or innovation. For instance, a technology company might preserve high R&D spend despite low short-term returns, viewing it as investment in intellectual capital. Recommendations must therefore reflect context, recognizing trade-offs between short-term financial performance and long-term strategic positioning. Integrating ratio-based analysis with strategic frameworks such as Porter's value chain or the balanced scorecard ensures that financial prescriptions reinforce competitive advantage. Actions recommended on financial grounds inevitably impact the wider organizational ecosystem, encompassing employees, suppliers, communities, and the environment. For example, cost-cutting measures may improve margins but harm employee morale or supplier relationships, weakening social and relationship capital. Conversely, sustainable sourcing initiatives may reduce short-term profit but strengthen long-term resilience and brand reputation. Finance professionals must evaluate these trade-offs holistically, ensuring recommendations balance profitability with responsibility. This integrated perspective aligns with the International IARB framework's emphasis on multiple capitals: financial, manufactured, human, social, and natural, and the long-term consequences of management decisions. Communicating recommendations effectively is as important as formulating them. Management accountants must translate analytical findings into clear, actionable proposals supported by quantitative evidence and sensitivity testing. Recommendations should specify expected financial impacts, e.g., margin improvement, cost reduction, or capital efficiency, and associated risks. Visualization tools, such as dashboards, scenario matrices, or prescriptive analytics models, help communicate complex interdependencies to non-financial stakeholders. Effective communication ensures decisions are informed, evidence-based, and aligned with the organization's risk appetite and governance structure. Ultimately, recommending actions based on financial statement analysis represents the synthesis of all analytical stages: descriptive, diagnostic, predictive, and prescriptive. It requires not just technical skill in ratio interpretation but strategic insight into how actions affect value creation across the ecosystem. High-quality recommendations are forward-looking, data-driven, and integrated across financial and non-financial dimensions. They anticipate the consequences of change, align with the business model, and promote sustainable performance. In a mature analytics environment, finance professionals act as strategic partners, using predictive and prescriptive insights to shape decisions that balance profitability, resilience, and long-term stakeholder value.